Welcome to our third quarter investment update. My name is Don Wilson. I'm our Chief Investment Officer. Joining me today are John Darby and Mike DeWitt, two members of our investment committee. A lot has been taking place in the investment and the economy this year, and so we're going to be talking about that. We'll talk about inflation. We'll talk about the bond market. We'll talk about the housing market and the strong dollar. We'll also talk about recessions and how we've been managing our clients' portfolios during this time. So to start us off, John, let's talk about what's been going on with some of the major asset classes for the quarter and year to date.
So we just had the third consecutive quarter of losses in both stocks and bonds. So let's unpack that a bit. For stocks, we're still in a bear market. U.S. stocks were down almost 5%. There were no major divergences within different categories, so large companies and small companies had similar returns. Faster growing companies were down a similar amount compared to cheaper companies. And overall, the losses were pretty modest. But because of the path that returns took, it probably feels a lot worse than the numbers might suggest. So earlier in the summer, we had a nice double-digit rally, and things were looking a lot better. But since then, we've had another sell-off. Stocks are down at new lows now, and we're very much still in a bear market. And the primary driver of returns continues to be inflation and the Federal Reserve's response to inflation. So a few weeks ago at one of their meetings, the Fed was very clear in communicating that bringing down inflation is their top priority, and they're going to do whatever it takes to accomplish that, even if it means unemployment rising or sending us into a recession. And so the market responded accordingly. On the international side, it was also a challenging quarter, and a big part of that was currency. So the US dollar has been very strong this year, and what that means is it's a good time to travel overseas. Your money's going to go a lot farther, but from an investment standpoint, that serves as a headwind for US investors. And so between that and, of course, a lot of geopolitical unrest, it was a challenging quarter on the international side as well. Moving on to bonds, bonds were down yet again, extending losses in what continues to be the worst year for bonds in history. Interest rates rose above investor expectations, so you can see the long government bonds got hit the hardest, but credit markets were actually okay. Credit held up fairly well. You can see high yield bonds were just barely down for the quarter. And we'll get into a lot more detail with the bond market later, but for now, with all these red numbers, I thought I'd leave you with two reminders. So one is that bear markets are inevitable. In order to get a return, you have to be willing to accept risk, and so we get that risk premium because of markets like this and downturns like this. And so this is just part of investing. It's the dues that investors have to pay for those long-term returns. And then second, bear markets create opportunity. So stocks are a lot cheaper than they've been for a while now, and there's some really attractive areas within the stock market. Also, bonds and cash are paying a lot more in interest than they have in quite some time. So that sets us up well for returns moving forward. So even though it's been a challenging year, there's definitely still some reasons for optimism in the markets. With that said, let's dive into a few specific areas of the markets and the economy. Don, talk about inflation.
There's been a lot of stories this year about many things in the economy and the markets, but none bigger than inflation. Inflation has been in hiatus really for the last 4 decades, since Paul Volcker back in the 80s as the chairman of the Fed really sought to crush inflation. And we've been in a period of falling inflation ever since, so for the last 4 decades, really up until about a year ago when inflation has reappeared, and it's back to levels last seen in the 1980s. And so why? What caused that? Well, the pandemic, if we push back to or rewind back to the pandemic, had a huge impact both on the supply side and the demand side of the economy. On the supply side, businesses and manufacturers weren't able to produce the goods and services that they had been producing. On the demand side, many people had lost their job or weren't going out and doing the things they had been doing, and so demand also came way down. The Federal Reserve, as well as Congress, implemented tremendous amounts of stimulus, And that helped to bring demand back, but it really wasn't able to do a lot to help supply. And so that is a classic definition of inflation. When you have too much money chasing too few goods and services, prices go up. And that's what we've seen. Now, where do we go from here? We are seeing supply starting to improve. One of the bottlenecks that came about during the pandemic was the congestion of ships at ports as they sought to unload their cargo to bring it into the United States. And take a look at this chart, and you can just see this reflects the number of ships that were waiting on the West Coast to unload their cargo. And that number really spiked up until the beginning of this year. But we're seeing that come down. It's come down tremendously. And so that's an improvement on the supply side. Similarly, the price of a container to ship goods, that price spiked during the pandemic. But we also are seeing those prices come down tremendously as well. So supply does seem to be improving. On the demand side, the Federal Reserve has been very aggressive in raising interest rates. Take a look at this chart. And this chart shows the Federal Reserve's height-raking cycles going back to the 1980s. You can see that this cycle in blue, the Federal Reserve has raised rates at the fastest pace going back to 1980. And so we do expect that that's going to slow the economy. It's going to make it more expensive for purchasing things like homes or cars. We are seeing a slowdown in those markets, and for businesses as well to expand. So we expect that the combination of improvements on the supply side, as well as actions that the Federal Reserve is taking to bring down demand, will bring inflation lower. Maybe not back to the levels, the ultra-low inflation levels we had for much of the past decade, but we do expect inflation to improve, and we expect to see that here in the coming months and quarters. Mike, talk to us about what's going on with the U.S. dollar.
Okay, sure. John, you mentioned earlier about traveling overseas, and this summer my wife and I had the opportunity to go to Europe, and she was pleasantly surprised to find that $1 equaled €1. And this was a big change from just about a year ago. A euro cost $1.25. And so she found that her dollar bought a lot more than it had previously. This was good news for her and good news for shopkeepers in Europe, maybe not so good news for me. But, except when traveling, most people don't tend to think about currency exchange rates. But given that an estimated 90% of all transactions globally have the dollar on at least one side of that transaction, there are important implications for the global economy and for investors. Now, currencies typically only move a fraction of a percent on a daily basis. And so to see the dollar appreciate almost 20% against a basket of foreign currencies, as it has in the past year, is a remarkable move. And it bears unpacking a little bit. So what's the cause of the appreciation in the dollar? So one thing is the dollar is considered to be a reserve currency. So in times of global crisis, which we've certainly had our fair share of recently with inflation, with the slowing growth rates, the war on Ukraine, foreign investors often seek out the safe haven of the dollar, so they sell their foreign currencies and buy the US dollar. That causes the dollar to appreciate. A second reason that you all alluded to earlier is the Federal Reserve has been faster and more aggressive in increasing U.S. interest rates than have global banks elsewhere. Those higher rates are attractive to investors overseas. Again, they sell their foreign currency, buy dollars in order to invest in the higher rates. That also pushes up the value of the currency. And a third related reason would be the inflation in energy costs, particularly for importers. Europe is in the news in this area for sure with the war on Ukraine, because they buy energy in dollars. Those energy goods cost more than they do relative to the U.S., where we have mostly energy independence at this point. Now, is the dollar's strength a good thing or a bad thing? Well, like so many things, it depends. one thing, it's about the only investment year to date that's showing a gain, an appreciation. And now most people don't invest directly in currencies, and we wouldn't really suggest speculating in currency prices. But again, there are important implications for stock investors. Now, companies located overseas who have foreign sales, they're getting a benefit from the strength of the dollar in their weaker currency when they translate their sales back into that currency. Burberry, the UK luxury goods producer, was in the news just last week saying it's adding over $200 million in its net revenue this year just due to the currency movement. Now, the opposite is true for U.S. companies that have large sales internationally. Nike and Microsoft are a couple of big names recently in the news having the opposite impact. When they translate their sales back into the U.S., the stronger dollar hurts their revenues. And so this is an important thing to keep in mind because a lot of people forget in the S&P 500, over 30% of the sales of those companies come from overseas. In the tech sector specifically, it's more like 60%. So we want to look in coming quarters to see the impact that currency is going to have on their profits. The biggest implication is for our investors who own international stocks, as we do for clients. Just as the companies take a hit when they translate their dollars back, investors take a hit when the dollar is strengthened and they translate those foreign returns into the U.S. So to give you an example, year to date, a broad basket of global stocks is down about 9% in the foreign currency. But when you translate that to your U.S. dollars, the return is negative 18%. So that's a pretty big impact. Now, given that fact and the fact that U.S. stocks have outperformed international stocks for quite a few years, some investors ask, what's the value of even investing internationally? Well, one, these things come in ebbs and flows. We believe international stocks will again have their day. One of the reasons is, as John alluded to earlier, the valuations on international stocks are much lower, and that makes their future return expectations higher. The other reason, though, is this currency impact. So just as trees don't grow to the sky, the dollar has appreciated. It may continue to appreciate more, but at some point it will probably come back closer to historical levels. And when that happens, investing internationally for U.S. investors, that'll be a tailwind instead of the headwind it's been the last few years. So with that, Don, why don't you talk about the historic move in interest rates and what that means for bond and cash investments?
It's been the worst year for bond and bond investors on record, going back to the 1970s. Normally, when stocks are down, when we're having a difficult stock market period like this year, investors take solace that their bonds are holding up well. That has not been the case this year. To understand why, take a look at this chart. This chart shows what's called the Treasury yield curve, and it shows different yields on Treasuries for different maturities. And so the bottom blue line shows these yields available at the beginning of this year. And the best yield available, if you were willing to loan money to the U.S. government for 20 or 30 years, they would pay you about 2% per year. If you were loaning money and the maturity of those bonds were 3 years or less, you were earning less than 1% on that bond. Fast forward just 9 months to today, and the yields that are now being offered, almost from 1 year out all the way to 30 years, are 4%. So we've seen a huge move up in bonds, and that has been the reason that the price of bonds have come down as much as they have so far. The silver lining is, for bond investors, we've been wanting and looking for higher yields for these bond investments for years, and finally they're here. So it's been difficult and painful getting to this point, but from here forward, the outlook is much, much better. For our clients who have significant assets in bank accounts, in savings accounts, take a look and see what you're getting, what you're earning now on those savings accounts or checking accounts. In some cases, your bank may have raised rates in line with the rise in rates, and you may be earning much more. Or in other cases, maybe not so much. And so we do think this is a good opportunity to see what you're doing there. And there's some good alternatives now. Many money market funds, short-term CDs, or short-term treasuries are yielding much, much more. And so you do have an opportunity to earn a much better yield on your short-term cash as well. So bottom line, we've seen rates move much, much higher this year. That's been very tough on bonds so far, but it does mean that we have good yields from here going forward. John, talk to us about the real estate market.
The real estate market is such a key part of the U.S. economy. So let's first focus on single-family residential homes. For many of us, our home is one of our most valuable assets. Housing affects consumer confidence, consumer spending, borrowing, and is directly tied to a lot of major industries like banking, raw materials, construction, et cetera. And a lot's been going on in the housing market. So the last 2 years, obviously, we've had tremendous growth in home prices with low inventory, low interest rates, a lot of people on the move. A lot of us have anecdotes, like I know I do, about people offering to buy your home, calling you, or sending you a letter offering to buy your home sight unseen, above market value. However, that's all changing. With interest rates up now, mortgages have more than doubled in just the last year, which has a tremendous impact on monthly payments and really limits affordability. So let's look at an example to see how this plays out. For example, if you take a house that sold for $500,000 just 1 year ago and you assume a 20% down payment with a 3% mortgage, which is what you could get at a fixed rate for 30 years just a year ago, that translates to a monthly payment of $1,686. Fast forward to today, 1 year later, if we assume a 15% increase in the sale price, which is about the national average, if you can still make that 20% down payment, you're now looking at a mortgage just under 7%, which is a monthly payment of $2,968. So that's a 76% increase for the same exact home as 1 year ago, which in dollar terms is almost $1,300. And so extrapolate that across the nation, and that's what you're seeing in the housing market, which really puts a cap on demand and is going to really slow things down, and you're probably going to see a lot of price drops across the country. With that said, we don't think this is an all-out crisis like 2008. There's several reasons we think that we're in much better shape overall. So number one, consumers have much better credit than they did back then. Number two, homeowners have a lot more equity cushion. And then three, banks are much better capitalized. So while we don't think it's an all-out crisis, we do think that there's going to be some major challenges ahead for the housing market, and you're probably going to see prices fall in many regions across the country. I also want to talk about commercial real estate, because when we think about how we invest in real estate, it's generally done through commercial. And that consists of office buildings, retail, so stores, multifamily, which is apartments, and then industrial, which is manufacturing facilities and distribution centers. And the big question around that is, with higher inflation, is real estate still a good investment as an inflation hedge? And the short answer is yes. Real estate, particularly private real estate, has performed quite well lately. You've had property values rising, you've had leases getting renewed at much higher rates, and a lot of the time within leases there are inflation escalators, so that automatically adjusts upward with inflation. So overall, commercial real estate has done well. One caveat that I should throw in is that there can be really big differences in public real estate, which is real estate companies that trade as stocks, versus private real estate. So implementation matters. It really matters how you invest. But overall, especially focusing on the private side, real estate has held up well with higher inflation. So let's move on to another topic. Mike, there's still a lot of talk of recession, so talk about that.
Sure. Last quarter, we talked about the possibility of recession. As of right now, it appears the odds are increasing that we'll have recession in the U.S. and maybe some other countries around the globe. Now, as you're aware, the Federal Reserve increasing interest rates to fight this 40-year inflation that we're seeing. Those rates are having their desired impact. They're cooling the economy, and that's good to a point, but the Fed is now trying to engineer this Goldilocks kind of scenario where they achieve what they call a soft landing, where they slow the economy enough to bring inflation down, but they don't slow it so much to push us into recession. So we'll see whether that's the case or not. Now, the quarter ended in June marked the second quarter of declining economic activity. So by definition, that's a contraction over 6 months. That's kind of the armchair quarterback definition of recession. It's not been officially declared, just to reiterate for the people keeping score at home. The official arbiters of recession define it as a significant, widespread, and prolonged downturn in the economy. Now, when you look at any number of economic indicators, some of those words are being used to describe. There's a few places where it's not, namely jobs. Over 2.7 million jobs were created in the United States in the first half of this year, and it would be really rare to have an official recession declared with such a strong job market. We've got unemployment at record lows still. Corporate profits hit all-time highs during the second quarter. And so that's also something that you would normally see coming down during recession. Now, in the case of jobs, that's very much a lagging indicator. So by the time we would start to see layoffs and the like, we would probably already be in the recession. So we'll see if that begins to move up. I want to go back to one thing Don was talking about earlier in his piece about bonds. And if you look at this chart, again, of the yield curve, this picture of what interest rates look like, again, the blue line is rates a year ago and what they normally sort of look like, an upward sloping line where lower rates on shorter term loans, higher rates on longer term loans. That's sort of normal. The red line is where we are today, and as we discussed, that's good news for bond and cash investments going forward, but it's not so great news usually for the economy. Economists like to call this an inverted yield curve. That's just a fancy way of saying that short-term rates are as high or higher than long-term rates. That's not a great scenario for bank lending, for other arbiters of the economy. And so we're watching that. If you want to look to something that would indicate we're having a recession, that's a fairly good indicator. As a sort of validation of that, since post-World War II, every recession we've had in the United States was coincided with an inverted yield curve. Now, we have had an inverted yield curve without having the recession a couple of times, but most of the time that's not the case. So at any rate, at this point, a recession, if it comes, it feels a lot more like a normal sort of business cycle run-of-the-mill recession to me, where the economy gets too heated up, the Fed raises rates to cool it down, it gets too cooled down and goes into recession. That we don't see, again, that crisis type situation like the '08 housing market John talked about, or the pandemic in 2020 and what we saw happen there. So then, somewhat encouragingly, the Atlanta Federal Reserve Bank publishes what they call GDP Now. It's kind of a boots on the ground, real-time measure of economic activity. It's very volatile and it gets revised a lot. But as of right now, it's predicting fairly strong growth in the third quarter. So we'll see what happens. But at any rate, the important thing for investors to think about, whether we have a recession or not, and we know we will eventually, it's an inevitable part of the business cycle, but what do we do about it as investors? And here's two things to keep in mind. First, as you can see here, the economy spends a lot more time expanding than it does contracting. The average expansion lasts almost 4 years in the United States, the average contraction just about a year. So if we do have a recession, they're typically not very long-lived. This too shall pass. The second thing to remember is the markets are always forward-looking. And so just as they have turned down right now, year to date, perhaps in anticipation of a recession, so too will they turn the corner and start rising before a recession has come, and usually before it's even been declared. So this is good news. According to researcher Morningstar, since World War II, the average return on stocks 1 year after the recession is over 22%, and it was positive each and every one of those times historically. So whether a recession is imminent or not, the advice for investors is similar. It's stay diversified, it's don't panic and sell out, and it's take the opportunity to rebalance into stocks while they're on sale. Don, I know investors are curious to hear what we're doing in client portfolios now. Why don't you talk a little bit about that?
It is a question we get. How are we managing client portfolios in this environment? And I think most of our clients are aware, but we have a team of people who are focused on managing our clients' investment assets. John and Mike and myself, as well as others, are part of the investment committee. We're meeting on a regular basis to talk about what's going on in the economy, what's going on in the markets. How are our current managers doing? What are they doing? And are they meeting our expectations? We're also looking at new investment opportunities for clients in seeking to upgrade the portfolio when we can. And so on an ongoing basis, we're communicating, listening, reading from what our current managers are doing, also talking with and looking at new managers. We have expectations for what those current managers should be doing, and sometimes they don't meet those expectations. So recently, we've had a small cap value manager in many of our clients' accounts that haven't been meeting our expectations, and so we made trades. We replaced that manager across many of our clients' accounts. Earlier this year, we did the same thing with some bond fund managers who we found better opportunities and wanted to make a change, and did that in many client accounts earlier this year as well. So that's part of our ongoing management process. We also find that volatility in down markets creates unique and special opportunities to add value for clients as well. And so this year in a down market, we are looking, and as usual, there's parts of the portfolio that are down. By making trades, we can do things to help our clients save money on their taxes next year. And so we've been doing that across many of our clients' taxable accounts. As well, I think volatility highlights the just disciplined investment process that we follow. Anytime that you have markets moving and volatile, you're going to have some areas of the investment market down more than others. And we want to keep our clients' portfolios strategically positioned. And so when we do have these moves in the market, it gives us a chance to systematically buy areas of the market that are now more attractively priced, and to fund those purchases with areas of the market that have held up better. And so that's a process that we've been doing. The third thing I'd say is that volatility creates opportunity for active managers. In talking with our managers, they tell us that there's a lot of times that great companies, great stocks, are getting thrown out and sold off in the same way as companies that are not doing so well. And so this gives them a chance to buy these really strong companies at very attractive prices. And that's what we hear that they've been doing. So down markets are not something that we want. No one does. But it creates opportunities for us to do things to add value for our clients' accounts. And that's what we've been doing. All right. Thank you, Mike. Thank you, John. And thank you all for joining us. As always, we hope that you have found this informative. And if you have any questions, please reach out to your advisor. Thank you.